So today, what I want to talk with you is this exact week that was the perfect playbook when it comes to the CPI week. So before I go into explaining in detail the 15-minute chart and the lower time frame charts, I want you to understand and to remember the rule sets that we've had and we have for the CPI weeks. In the CPI weeks, we will not trade the day ahead, and I would not consider the Monday for this trading week. And even in general, I would prefer to trade the CPI weeks after the CPI on Wednesday, as I anticipate the week to accumulate and manipulate throughout Monday and Tuesday, which is exactly the playbook that we have right here, which is absolutely beautiful. What I was targeting above prior to the week opening was this level, which is at 25% between my yearly standard deviation from, for instance, this is a standard deviation, and the next standard deviation, if we take a fib and we put at 25%, the 50%, and the 75%, the 25% of that range is going to be the 25% BT. So between targets, that's essentially what it means. So if this is an unrealized target, which can be used as a liquidity pool because standard deviations are just the other buy stops in this case that we're going to target. So for instance, retail traders are going to have their stop losses at the level of buy side and above it to protect their resistance stop losses. Like they're trying to short on resistance and they're going to place their stop above the high. So how much above the high is we're going to see the price deliver. This is exactly what a standard deviation is. So this was an unrealized target, which we were targeting for the week in itself. What we saw throughout Tuesday was a beautiful delivery where we took Friday's level of sell side. We saw the market going back into the daily busy. We had the market opening, going back into the mean threshold of this, lower into the 50%. We never reached the 25%, which is a sign of normal market delivery. And then we ended up closing above the busy, which means that we're going to further continue to the upside. Therefore, for Wednesday's candlestick, knowing that I anticipate the market to go higher, I would want to see this as a means of the third candlestick of a swing low. And I would prefer, if we are indeed in a strong market, that the market does not even go into the 50% of this tail, which is exactly what happened. So the market closed above, which means that we open here. I would want to see the market deliver back into the daily busy high or the 25% or 75% of this tail, and then I would want to see the price go higher into this target. The 50% of this order block, this daily order block would be a daily target to aim for. And if I see the market on a 15-minute chart closing above it, then it means that it failed, and I want to see the market use it as a means of support. Same thing with this consequent encouragement of this wick. So everything in this instance should work. For instance, if I want to see this as an order block, then it means that the market should go above its high. So therefore, I would use the 50% of it and the 25% and all of these levels so that if the 15-minute chart closes above it, then if the market opens and goes back into these levels on a 15-minute chart, then once it does it, I will go back into a 1-minute chart and I will look for our entry model. Market opens, goes back into this. And I've also annotated the fact that we have a breakaway consequent encouragement of the tail, exactly what I've talked, which is a sign of strength. Inside of a 15-minute chart, what we can see is the market taking on this level of sell side. This level of sell side inside of the London session, we have the market going above it, which would label this as a market structure shift. So our new current dealing range is going to be from this low up into the high that is created. Market creates a reversal, not reversal, but the market goes back below this level of sell side. Back, it creates a retracement back into this order block and this fair value gap. And once we leave it, we leave this breaker, which after we close above it, we come here back and we use it. we leave this as a means of a breakaway gap, which is a sign of strength, and then the market goes higher with speed. We will not trade this candlestick because this is the candlestick that is responsible for the 830 CPI, but we can trade afterwards. And what do we see afterwards? Well, we see a big displacement to the upside. We see the market going higher to the upside, taking also this high. And if we're trying to target for this Tuesday buy-side liquidity from the AM session, if we're aiming for this, then what I want to see is this inversion gap to fail. And once I'm looking at the 15-minute chart and I see everything, the low of the day being created in what? In the London session. We failed to reach the 50% of that sell, so that gives me strength. So this means that when this candlestick closes, once this candlestick opens and it goes back to the low of the inversion gap, knowing that I want to see speed, what I'm going to do in that exact moment is I'm going to switch to a 1-minute chart. So again, this is a rule set. The market opens, goes higher into the 50% of the inversion gap, and I will only switch back to the 1-minute chart once I see this exact signature. The market closes the candlestick at 830 to 845, somewhere around here. Then once the market goes back into the low, I'm going to consider between 850 and 910, I'm going to wait for the market to shift. Market goes below this level of sell stops into this BC. And then once the market takes on this high, market closes also above the 50% of this 50-minute inversion gap, which tells me that we're going to go into the 75%. Market does indeed that. It also shifts, and the sole purpose of this whole dealing range was for the market to retrace back into this BC to make it balanced. And once we close above this 1-minute inversion gap, once the market goes back into it, because I know that this dealing range is now balanced, so there's no reason to go back into this fair value gap, which we've left open. And I anticipate the market to begin the expansion to the upside, so I would not take any position here because this is a retracement back into a BC. Once the market takes on this high, this is a balanced price range dealing range, and every singular retracement back into this inversion gap, I know that it is going to be short-lived and it is not going to create a big retracement. This right here would be the point of entry in which we've had stacked PD arrays, the inversion gap. We know that this is going to be a breakaway gap because, again, everything that I've told before. And this is also an order block, which is what? Which is going to be linked with the expansion, underlying expansion that we're anticipating. And I know that your point of entry is an inversion gap. And also the 50% of this inversion fair value gap on a 50-minute chart. So once the market goes back into it, I will take an entry. And my stop loss, because I do not want to see the lower half of this inversion gap, if I am correct, it will be at the lower half of the inversion gap and ultimately even below the inversion fair value gap, because if the market goes there, then I know that I'm wrong and I will never gauge the market ever again before the 9:30 opening. The market goes back, I'm inside of the market, I have my stop loss here, and I target for the 15-minute inversion bearish order block mean threshold, or the Tuesday buy-side liquidity pull from the AM session, or I'm going to aim for some standard deviation level inside of this deviated movement. Market opens, goes back into the 50% or 75% of this candlestick's tail, and then we close above this higher time frame inversion gap, which tells me what? It tells me that the market is going to open, is going to use this as support, and I would never want to see the market back right now into the inversion gap consequent encouragement. Market goes higher, and then what I do when these candlesticks paint is I'm going to have my target. So let's just assume that we're going to target the -2 standard deviation. What I'm going to do is I'm going to put the implied dealing range. So from this low up into this target, because this target is unrealized, I'm going to name it an implied dealing range because these candlesticks do not exist yet. From this low up into this, once the market reaches the 75% of this, then what I will do is I will place my stop loss at break even. But let's assume that this is our target. What I will do until we reach that target is I will constantly measure whether the market is going to retrace back below 3 PD arrays. Market goes higher, I see a lot of signs of speed, so breakaway gaps. Market closes above the 15-minute inversion bearish order block mean threshold, which means that we now have to go inside of the 75% of it, and ultimately it is going to fail. So this also tells me that my bias and narrative is strong for the 1-minute chart. And then throughout these retracements, I constantly look. 1 PD array, okay, it failed. 2 PD array, and then ultimately, I would not want to see the market go below this order block, which right here is also a swing low. So this tells me what? This should be an intermediate term low until we hit this target. Market goes higher, goes back into the order block once again, fair value gap, mean threshold, and ultimately if the market closed below the mean threshold, I would not want to see price anymore higher. I would either close the position or I would trail my stop loss to the last PD array. Market goes higher, and then ultimately our target is reached. So the market is going to use the 75% of this inversion gap on a higher time frame chart, and then it's going to ultimately leave to the upside. So I know that after we close above it, we do not have to go back into these levels. So my entry is positioned in a place in which if the market goes there, then I know that I'm wrong, and I am grateful for the fact that I was shown that I was wrong, and I would not be wrong anymore, because if the market goes back below this low, then I would lose more if I did not have a stop loss. That's pretty much it. All right, let's see.
Okay, so here is my question. Maybe later you can respond to it. Okay, so this is this week, all right, this week's candle. So I can see that there's this propulsion order block here.
Okay.
Okay, order block
Okay.
on the weekly. Okay, and then if I go to the daily, I can see that there's this uh, daily BC here.
Okay.
Okay, so then my question would be, okay, so this is Monday, Tuesday, Wednesday, Thursday, Friday. Wednesday being a CPI day. So CPI day, no trading on Monday and Tuesday.
Okay.
We are trading Wednesday after CPI, Thursday and Friday. So my bias would be to go longs, to go for buys. So I can see that this Tuesday here closed, rebalance this BC and closed above the BC high.
Okay, this is a question that I've asked, not asked, but this is a question that I've answered instead of the video. So I'm making this video after the one that I've did yesterday, because I've had some time prior to my father's birthday in which I have done that video. But I believe that I've answered to this instead of the video that I've did before. But let me just see what you have said.
Okay. So since Wednesday is a CPI day, this is Monday, this is Tuesday, no trading. We are currently on the 15-minute chart. Okay, so for the 15-minute, let's say CPI is at 8:30, and
I've answered this and that in the last video or in the previous video that I've did, so I don't believe that we have to talk about that specific day. Let me just see what you've said here.
okay, so this is my second question.
Okay.
Okay, this I remember you saying that 7 until 8:30 is also another range,
Okay.
another time period besides the London Asian AM and PM
Okay.
and lunchtime. So assuming I'm looking for a buy, my bias is a buy. Okay. Assuming for that day my bias is a buy.
Okay.
Okay, please don't look at the Tuesday 10 December. I know it's not a day for trading, but assuming it's a normal day for trading and my bias is a buy,
Okay.
could you expand on this 7 to 8:30 and also this 9:30 to 10:30, what you mean by consolidation? You look at the first opening.
Of course. So let me just tell you what I do with the 9:30 to 10:30 range and how I use it in terms of trading the lunch session. So in this day, I assume that I haven't been trading for the past week, but I assume that this is the Tuesday prior to CPI. So in terms of our bias, this would be, I mean, of course, if you are trying to go long on this Tuesday inside of an intraday model, aiming for those buy stops that you have like right here. If you're trying to trade up between 8:30 and 9 or prior to the 9:30 opening, you can take something in terms of this buy side, have some standard deviations and trade for them. But in terms of the 9:30 to 10:30, if we are trading, I mean, we're here, the candlesticks are painting here, and I anticipate this. I mean, I anticipate the weekly chart to go to the upside. So this Tuesday, I would anticipate this to be the manipulation day. Therefore, between 9:30 and 10:30, if we see the market going to the upside or consolidating like we have in this, I'm going to take the information that the market consolidated, and within our previous session liquidity attack model, we're going to understand that when this time period starts, the 10:30, then this can start the lunch session rate, which means that the market is going to go and target the people that have been long or short throughout the last period of time. So between 9:30 and 10:30, what happened between that time period? Well, we've consolidated, but we've moved to the upside. So this means that we're going to do what? Lower, higher, taking a level of buy side, market structure shift, market goes back, here, CB, what happened between 9:30 to 10:30? Well, we went higher, so therefore what am I going to target? AM sell stops, AM sell stops, AM sell stops. If the market was going to the upside higher, 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 and then we were anticipating the market to continue higher throughout the day, then the 1050 to 1110 macro would be used for the market to go to the upside even more. This is the reason why the silver bullet model, the ICT silver bullet model, is between 10 o'clock to 11 o'clock. Because if the market is going to consolidate, then at 10:30, the market is going to attack these people that were long throughout this movement.
Hour. What are you looking at the first opening hour? So is it possible for me to take a trade down here at 8:50 to 9:10 macro? I see that this liquidity has been taken.
Yes,
There's a market structure shift,
correct.
and I can aim for this.
Exactly what I've talked about. If you are anticipating the market to have a consolidation for the entire day, then you can absolutely trade inside of an intraday volatility model, where you do not trade with a bias, you just trade the intraday volatility, which means that after the level of sell side has been taken, you're going to aim for the opposing level of sell side with half of buy side in this case, without having big expectations that the market is going to continue within that direction. As you can see, 1 PDRA, 2 PDRA, and then this. I would not want to see this normally if I'm looking at the market, if I'm looking at a one directional market. But if you're going to try and trade intraday volatility, then you have to allow these movements to happen. And this is why you trade intraday volatility with a lower leverage than you would do normally. Okay, let me just go into the next one.
Okay, so this is the last video
Okay.
when it's attacking liquidity pool,
Okay.
not FVG.
Okay.
Okay, I can see that just slightly before the macro, or can be during macro as well. Price took out this liquidity.
Okay.
Okay, this is the 1 minute chart. Assuming my bias is to sell.
Okay.
Okay, of course, on this week, I'm only supposed to be looking for buys.
Okay.
Okay, based on my weekly bias
Analysis.
and all.
Yeah.
So assuming I can go for the sell at this point here, is this the market structure shift?
When we have situations like this, when we have a big run and we're looking for a reason to go down into this level of sell side or some level of discounting efficiency, what you're going to look for is the opposite that we look in terms of a confirmation bias signature, which means that I'm going to take 3 PD arrays from this range. First of all, I'm going to understand what the dealing range is. So this is the low that sent price higher above this level of buy side. So this is the range. This is also an intermediate term low. So if the market goes below this, then this would mean that this is invalidated, which we can see right here, right? So the market took this low, made a premium run back into this dealing range, but this is our dealing range. So when we're trading here, this is our first P rate. This is the second P rate that I would take. I would not take this one because we can see the market going back into a discount if it were to continue higher, and this would be the third. So you can take this run back into a discount. The market goes higher and it fails to go above this high. So this is the low that I would consider for a means of a market structure shift. The market goes lower, you can take a trade instead of this inversion gap if you so choose. Stop loss above the consequent encroachment of this. This is also the 25% of this wick, which tells me that this is a weak movement. Market goes back into it. Once again, your protective stop is safe here because this would be an intermediate term high right here, targeting the sell stops. So I would take this as a means of market structure shift again because we have the dealing range. Here, market goes back into some form of an equilibrium or a discount. Market goes up, higher. I wanted to say higher than up in the same time. And then we're going to look forward for a movement back into a discount or back below a level of sell stops. So this would be a fine target. And then you could have been out right here, which would be fine in terms of a risk to reward model because you would short here, have your stop here. This target, it allows you to have more contracts, which I do not advise you to. But this could be done. If you miss this movement, you're going to wait back for of course, it's very easy to talk instead of a back testing perspective, but you can wait for this. You can see consequent encroachment of this wick here, a failed fair value gap, and then you anticipate the market to expand lower because we've done the retracement. This is why algorithmic phases is so important. Retracement, then after retracement, there's what? There's an expansion. So I'm waiting, I'm anticipating this expansion to occur. And then I'm going to look for signatures that this occurred indeed. Swing high, consequent encroachment, the market drops, inversion gap. If we see that as a breakaway, then that is this is a balanced price range because we have buy side delivery and then we have sell side delivery here with one candlestick to this balanced price range. If this is left open, then this is a sign of weakness. Market goes back into this here, doesn't even trade up into this, closes below 1, 2, and then ultimately this immediate rebalance fails as well. Going back into this could have been your entry. Of course, it is easy for me to say it right now instead of a backtesting model, but you could have shorted this right here, or you could have shorted this. Stop loss would be here because we do not want to see this being we do not want to see deep retracements because once again we're going to have an expansion. Market goes lower, auto block because we're looking for expansions to the downside with this Here, this could have been also taken as a balanced price range dealing range, because the sole purpose of this retracement was for the market to rebalance an imbalance, to move lower. This is done. We're looking for this because this is the intermediate term high, that same price lower below this level of sell side. This is our dealing range. Here, look at the bodies of the candlesticks below the 25% of this fair value gap. Market goes back and fills this fair value gap and then moves lower. I'm looking at this order block, and I'm just telling you how I see this price movement, right? So it can inspire some, I don't know, some anticipatory skills to you. But I also want to state the fact that within 2025, we're going to be more accentuated in terms of the mentorship. So our mentorship is going to be way better in terms of punctuality, in terms of our sessions, in terms of everything that we're going to discuss. It is going to be very precision oriented. So you're going to know everything that I'm talking about right now. But in terms of December, I did not trade very much. So this is why I'm not so close to the market right now. I just wanted to add this up to you right now so you know why the mentorship is in its state right now. Order block, market close below it. We can also use this order block failure as a means of correlating it with this PD array. Then the market continues to the downside. Let me just continue.
Or is this the correct market structure shift? I would say that this is the proper one lah.
Good.
What is your opinion? Is this considered a market structure shift, or this
one
is the correct market structure shift? Also, please explain with the other two videos and this video.
Okay.
How do I know that I should be staying in the trade and not closing my position? Okay. And what would happen that will require me to exit my position if I'm going for short?
So basically what we're looking at here is this dealing range from this low to this high. This is an internal range sell side. This is the external range sell side. So these are external points. These are extremes. When we're looking at this retracement, if we're looking at this retracement in terms of this dealing range, then this is a return back into a discount. So it would be normal and reasonable for the market to go back and create this deep retracement, right? So if the market does this, if I anticipate the market to go back to the downside, then I would not anticipate the market to take on this high or these highs. So when I see this, I'm looking at it in terms of this range high and this range low. So it is one PD array, if I cannot, the second PD array, and then we have this order block here, the 50%. If the market would have closed above the 50% of this order block, then I would cancel the trade from this inversion gap, and we would be in a losing position, but not as much as if the market would have went in this. You can see the market closing below the 50% of this order block, and then we can see it running away, and then we start measuring. Okay, the market doesn't retrace back into this. We eventually go back below this, so we would not want to see the market going back to this range because it was used as a means of a retracement. And if the market goes below this low, then I know that it has to continue with something with speed, because this would be an intermediate term low, as you can see. And we've also went below a level of sell side. So if the market would have continued higher, or if the market would have had the intention of going higher, then this should never happen, because we've took a level of sell side. So there's no reason for the market to be here if the market is going to continue higher. Market goes lower, fair value gap continues lower, 50% of order block, and then it continues lower below this level of sell side. This also here, and then it moves to the downside.
But the market is showing signs that it does
and
not.
We can also deviate this range, and you're going to have the exact low right here, and the 0.5 is going to be around here, this here.
Not to go for sells anymore.
Good. All right, so I'm going to also integrate the lesson that I've did for you in the past video. This one, I'm going to integrate it in this video. And for our 2025 perspective, Joshua, I want you to understand that we're going to be very focused in terms of your development. I know that in November and December we did not have active one-on-one sessions, and I have been caught up with some things in real life, but I am going to tell you that this year is going to be the best year of your life. So we're going to have live sessions, as I promised to you. We're going to have sessions in which we discuss what I believe the market's going to do, what we want to see in terms of a weekly bias, how we are going to approach the week in terms of our weekly bias and daily bias, and how we correlate the two, how we correlate the high impact news drivers, how we do everything. So if you have any more questions, I want you to leave them inside of the Telegram DMs, and I'll see you in the next one.